Bitcoin's grip on the crypto market is tightening, and it's starting to look like a brand new kind of monopoly. If you look at the Bitcoin dominance chart right now, the one metric showing Bitcoin's slice of the entire crypto pie, it's painting a picture every investor needs to see. For most of 2025, its dominance has been incredibly strong, averaging around 62 to 63%, and at times pushing towards 66%. This isn't just a random blip. It's a sustained level of control that signals a massive power shift. Whenever the market gets shaky, traders have consistently run for cover in Bitcoin, cementing its role as the ecosystem's safe haven asset. This isn't a quick, explosive spike from a speculative craze. This is a slow, grinding consolidation of power. The king is back, and it looks like it's planning to stay on the throne for a while. So why is this happening? This isn't just about price, it's about power. We're going to break down the two colossal forces driving this shift. The flood of institutional money pouring in through new regulated channels, and a powerful regulatory wall being built that separates Bitcoin from almost everything else. And of course, we'll tackle the billion-dollar question. What does this new Bitcoin monopoly mean for your altcoins? The answer is more complicated than you think, and it will likely define the winners and losers of this market cycle. If you're holding anything besides Bitcoin, you'll want to stick around for this. First things first, what exactly is Bitcoin dominance, and why do so many people call it one of the most important charts in crypto? At its heart, Bitcoin dominance, or BTC.D, is a simple ratio. It measures Bitcoin's market cap as a percentage of the total value of all cryptocurrencies combined. Think of the entire crypto market as one giant pizza. Dominance tells you how big Bitcoin's slice is. If the whole pizza is worth $2 trillion and Bitcoin's slice is worth $1.2 trillion, its dominance is 60%. But this chart is way more than a percentage. It's a powerful gauge of market mood and where the money is flowing. It tells a story about risk. When Bitcoin dominance is climbing, it usually means one of two things. Either fresh money is flowing straight into Bitcoin, or existing crypto investors are getting nervous. They're selling their riskier altcoins and moving into the perceived safety of Bitcoin. It's what they call a flight to safety in the crypto world. During market storms, Bitcoin acts like digital gold, a shelter from the chaos. On the flip side, when Bitcoin dominance falls, it signals that investors are feeling bold and ready to take on more risk. Profits from Bitcoin's climb get rotated into other assets in the hunt for bigger, faster returns. This is the magic that fuels the legendary alt seasons, where altcoins can go on explosive, parabolic runs, often leaving Bitcoin in the dust for a while. However, there's a wrinkle here that often gets missed. The dominance chart isn't a perfect crystal ball, and its reliability is a hot topic of debate. A huge factor complicating things is the explosive growth of stablecoins like Tether, USDT, and USDC. As the market cap of stablecoins has swollen into the hundreds of billions, it technically inflates the total altcoin market cap, which artificially pushes Bitcoin's dominance number down. That's why some analysts prefer a real Bitcoin dominance chart that strips out the biggest stablecoins. When you look at it that way, Bitcoin's share of the investable, volatile crypto market often looks even more commanding. It's a key distinction because money in stablecoins is mostly for trading and settlement, while money flowing into Bitcoin is a directional bet on the asset itself. To really get what's happening in 2025, you have to look back. The history of the dominance chart is the history of crypto. In the early days, from 2009 to about 2016, Bitcoin was the market. Its dominance was consistently over 90%. The idea of an altcoin was just a niche curiosity. The first real shock to this monopoly was the 2017 initial coin offering ICO boom. Powered by Ethereum, thousands of new tokens flooded the market, and a tidal wave of speculative cash chased after them. As investors hunted for moonshot returns, Bitcoin's dominance collapsed, hitting an all-time low of around 35%. This was the first true market-wide alt season. After the 2018 crash, a predictable pattern took hold. As the bubble popped, money fled the now toxic ICOs and rushed back to the safety of Bitcoin. Throughout 2018 and 2019, its dominance steadily climbed back into the 60 to 70% range. It was a harsh reminder that when the party's over, Bitcoin is where everyone gathers. The 2021 bull run was more complex. Bitcoin led the first leg up, but as things heated up, capital rotated into altcoins with incredible force, especially into the hot new worlds of DeFi and NFTs. Dominance fell again, sparking another massive alt season. But when the market topped out in late 2021, the cycle repeated. During the brutal bear market of 2022 and 2023, altcoins bled out against Bitcoin, and its dominance began its slow, steady climb once more. And that brings us to today, late 2025. What we're seeing now looks different. This isn't one of those sharp, panicky spikes. We're in a sustained period of high dominance. After climbing through the bear market, Bitcoin's dominance has solidified its position, often trading above 60% and hitting highs near 66%. This feels less like a temporary mood and more like a permanent structural shift. To understand why, we have to look at the new giants that have just stepped onto the playing field. So, why is Bitcoin's dominance so strong in 2025? Why is all the capital piling into the king, creating this new monopoly? It's not just one thing. It's a mix of three powerful forces that have completely rewritten the rules of the game. Pillar 1, the institutional stampede, the ETF effect. The biggest force by far is the institutional adoption of Bitcoin. The moment that blew the doors open was the approval of spot Bitcoin ETFs in the US back in early 2024. This wasn't just another headline. It was the construction of a superhighway connecting the trillions of dollars in traditional finance directly to planet Bitcoin. For years, big money players, pension funds, corporations, and asset managers were stuck on the sidelines. They loved the idea of crypto returns, but hated the regulatory mess and the risk of managing private keys. The spot Bitcoin ETF solved all those problems instantly. Suddenly, any financial advisor could get Bitcoin exposure for their clients with a single click right next to their Apple and Tesla stock. These ETFs are managed by the biggest names in finance, BlackRock, Fidelity, ARK Invest. And these are brands that compliance departments trust. The ETF was the golden ticket of legitimacy they were all waiting for. The result? A fire hose of cash. Since launching, these ETFs have pulled in a staggering amount of money, with reports in late 2025 showing net inflows have blown past the $50 billion mark. And this isn't flighty retail money. This is sticky long-term allocation money that isn't going anywhere anytime soon. Crucially, this superhighway has only one destination, Bitcoin. As of late 2025, there is no spot Ethereum ETF approved and trading in the US, let alone one for any other altcoin. For a compliance officer at a pension fund, the choice is easy. Bitcoin has a regulated, insured, and easy-to-buy product from BlackRock. Everything else looks like a wild, unregulated gamble. This creates a massive, constant demand for Bitcoin that simply doesn't exist for any other crypto. The ETF inflows mean fund managers are constantly buying real Bitcoin, soaking up supply, and creating a price floor that altcoins just don't have. The institutions aren't just playing in Bitcoin's market, they are remaking it in their own image, with Bitcoin right at the center. Pillar 2, the regulatory moat. The second pillar, which works hand in glove with the first, is the creation of a massive regulatory moat around Bitcoin. While the ETF gave institutions the how, the evolving regulatory landscape gave them the why. Throughout 2025, the story in crypto regulation has been one of separation, growing clarity for Bitcoin and growing confusion for almost everything else. In the US, the CFTC has long viewed Bitcoin as a commodity like gold or oil. This is a much friendlier label for a decentralized asset. Meanwhile, the SEC has been sending strong signals that it sees a huge number of altcoins as unregistered securities. The logic comes from the old Howey test. If a token was sold by a central team to raise money with the promise of future profits, it's likely a security. That label comes with a mountain of regulations that most crypto projects can't handle. This legal gray area has put a deep chill on the altcoin market. Big firms won't touch assets that might get slapped with an enforcement action, and exchanges are quick to delist tokens to stay out of trouble. But Bitcoin is different. With its mysterious creator, no ICO, and a truly decentralized network, it's almost impossible to call it a security. It is basically the only major crypto asset with a clear legal status in the US. This creates the regulatory moat. For a risk-averse institution, crossing that moat to buy altcoins is a legal minefield. Staying safe inside the castle walls and just buying the commodity, Bitcoin is the smart and legally safe move. This flight to regulatory clarity funnels capital to Bitcoin, not because it's the best tech for everything, but because it's the most legally sound. Pillar 3, the rock-solid foundation. The third pillar has been here all along, but it matters more than ever in this new institutional era, Bitcoin's bulletproof network. First, security. The Bitcoin network is secured by an incredible amount of computing power, or hash rate, which has continued to hit new all-time highs through 2025. This makes the Bitcoin blockchain the most secure ledger on Earth. Attacking the network would be practically impossible. Second, decentralization. The network is supported by tens of thousands of nodes, roughly in the range of 15,000 to 20,000 reachable ones spread across the globe. Each one validates every transaction, ensuring no single person, company, or government can control it. In a world full of DeFi hacks and centralized project failures, Bitcoin's boring reliability is a killer feature. It has run with near-perfect uptime for over a decade, a record no other major crypto can touch. Finally, innovation is still happening. Layer 2 solutions like the Lightning Network are making Bitcoin better for payments. And the controversial yet undeniable wave of innovation from Ordinals and BRC-20s has shown that new development is still possible, bringing new energy and builders to the ecosystem. These three pillars all reinforce each other. Network security gives regulators confidence to approve ETFs. The ETFs bring in institutional money. That money incentivizes miners to boost the hash rate, making the network even more secure. It's a powerful feedback loop that has cemented Bitcoin's monopoly in this new era. Okay, so we get why Bitcoin is king, but what does that mean for your portfolio? If for anyone holding altcoins, this new era presents a tough dilemma. The dream of a 1,000 times gem is clashing with the reality of a market that seems to be leaving most projects behind. The great bleed, why your alts are hurting. Ever have that feeling where your altcoins are losing value not just in dollars, but against Bitcoin itself? That's the bleed, and it's a brutal lesson to learn. It's easy to get fooled in a bull market. Your favorite alt might be up 20%, which feels great. But if Bitcoin is up 40% in the same time frame, you've actually lost ground. You would have been better off just holding Bitcoin. The great bleed happens when Bitcoin dominance is on the rise. New institutional money flows almost entirely into Bitcoin, creating buying pressure that alts don't get. At the same time, existing crypto investors see Bitcoin moving and rotate their own money out of alts and into BTC to catch the main trend. This creates sell pressure on altcoin/BTC pairs, causing them to bleed value against Bitcoin. In 2025, this has been a painful reality for most of the altcoin market. While certain narratives like AI tokens have had their moments, the broader market has struggled. The altcoin season index, which tracks how many top altcoins are outperforming Bitcoin, has been stuck in the basement for long stretches, confirming we're in a Bitcoin season. It's frustrating watching your carefully picked projects go sideways while the king marches onward. The capital rotation theory, the bull case for alts. This brings us to the glimmer of hope for altcoins, the capital rotation theory. This is the classic playbook for how a crypto bull market is supposed to work. It usually goes something like this. Bitcoin leads, the market wakes up, and new money flows into Bitcoin first. Dominance rises, profits flow to Ethereum. After a big run, traders take their Bitcoin profits and move them into the next safest bet, Ethereum. ETH starts to outperform BTC, large caps. Rally with even more profits and confidence, money then flows to other big established altcoins. Bitcoin dominance starts to fall fast. Alt season mania, finally capital cascades down into mid caps, small caps, and meme coins. This is the Wild West, where you hear stories of 100x returns, the flight back to safety, eventually the bubble pops. Fear returns and everyone rushes back up the chain, out of small caps and into the safety of Bitcoin and stablecoins. Dominance rises again and the cycle resets. This historical pattern is the main argument for why an alt season is still coming. It suggests today's Bitcoin dominance is just phase one, and we just need to be patient. But this leads us to the most uncomfortable question of this cycle. Is this time different? The bear case for alts. They say this time is different are the four most dangerous words in investing. Yet we have to seriously ask if the new market structure has broken the old rotation model. Think about it. The institutional money flowing into ETFs isn't coming from crypto natives looking to ape into the next hot meme coin. A pension fund buying the BlackRock ETF is treating Bitcoin like digital gold. When they take profits, that money is far more likely to go back into bonds or stocks, not into an altcoin. The institutional on-ramp is a one-way street to Bitcoin, and the off-ramp likely leads right out of crypto entirely. Then there's the regulatory moat. In past cycles, moving from Bitcoin to an altcoin was easy. Today, that path is full of legal landmines. Why would a major fund rotate from the legally clear commodity Bitcoin into an asset the SEC might sue tomorrow? The risk is just too high. This friction could act like a dam, stopping the capital cascade before it ever reaches the smaller projects. This could lead to a two-tiered market. The top tier would have Bitcoin and maybe a few other assets that get the institutional nod of approval, Ethereum being the next logical candidate. This tier would get most of the capital and see steady growth. The second tier would be everyone else, the thousands of other altcoins fighting over a much smaller pool of retail and crypto native capital. In that world, liquidity would be thin and volatility high. Instead of a rising tide lifting all boats, we could see a survival of the fittest market, where only altcoins with incredibly strong narratives, real utility, and die-hard communities can make it. The Bitcoin monopoly doesn't mean alts are dead, but it means the bar for success is now exponentially higher. So if the old playbook is broken, what's the game plan? Just buying a random basket of alts and hoping for the best might be a recipe for disaster. This isn't financial advice, but here's a framework for thinking about how to navigate the new era. Strategy 1. The barbell approach. One of the smartest ways to adapt is with a barbell strategy. The idea is to focus your portfolio on two extremes, super safe and super risky, and avoid the messy middle. In crypto, this looks like one end of the barbell, a huge conservative allocation to Bitcoin. This is your foundation. Given its institutional backing and regulatory clarity, Bitcoin is your anchor in the crypto storm. An allocation of 60%, 70%, or even 80% to BTC makes sense here. This side is for stability and capturing the main institution-led trend. The other end of the barbell, a small handful of high-conviction, speculative altcoin bets. This isn't about owning 100 different coins. It's about making a few concentrated bets on projects you think could deliver explosive, life-changing returns. This might be 20% or less of your portfolio. The key is to be extremely selective. You need to find projects with what I call narrative escape velocity. A story so powerful, tech so good, or a community so strong that they can defy Bitcoin's gravity. What qualifies? Maybe it's a project leading a hot narrative like AI or DPIN. Maybe it's a platform with a rapidly growing user base. The point is, the potential reward has to be massive enough to justify the huge risk. With this strategy, you accept that most of your moonshots might fail, but the one or two that hit could supercharge your portfolio, while your big Bitcoin bag keeps your base secure. Strategy 2, watching the dashboard for a shift. No matter your strategy, you have to be paying attention. You can't just buy and hope anymore. You need to watch for signs that the market is about to change. Here are the key things to look for that might signal a real capital rotation is starting. 1, a breakdown in Bitcoin dominance, the most obvious signal. I'm not talking about a little 1 to 2% dip. I mean a clear structural break below a major support level. A sustained move below 50% would be a huge sign that money is flowing into alts with conviction. 2, a change in ETF flows. Keep an eye on the spot Bitcoin ETF data. If inflows dry up for months while Bitcoin's price is flat, it could mean the first institutional wave is over. If that happens right as, say, a spot Ethereum ETF gets approved and starts trading, that could be the catalyst for the next leg of rotation. 3. The birth of a killer narrative. Alt seasons are always powered by a great story. In 2017, it was ICOs. In 2021, it was DeFi and NFTs. For a real alt season to take off now, a new narrative has to emerge that's so exciting it forces capital to look past Bitcoin. Whether it's AI, gaming, real-world assets, or something we haven't even thought of yet, the birth of that story could be the first sign that things are about to get interesting. The long-term outlook, a market growing up. The return of the Bitcoin monopoly isn't a fluke. It's a sign that the crypto market is finally growing up. It's shifting from a retail-driven casino to a more structured institutional asset class. And in this new world, the qualities that Bitcoin has, security, decentralization, and a simple story as digital gold are being rewarded above all else. This isn't the end for altcoins. Innovation will never stop. New projects will launch, and some will create incredible value, but the game just got a lot harder. The days of a rising tide lifting every single boat are likely over, at least for now. The Bitcoin monopoly is forcing a great sorting. Projects with no real use case or weak communities will struggle to survive as liquidity gets sucked up to the top. But the ones that are truly building something special, they won't just survive. They'll be perfectly positioned to thrive when the cycle eventually turns in their favor. The key takeaway is that the game has changed. Success in this new era means adapting to the Bitcoin monopoly, not fighting it. It means being more critical and strategic about how you build a portfolio that can both weather Bitcoin's gravity and still give you a shot at that explosive crypto upside. Look, the bottom line is this. Bitcoin's dominance in 2025 isn't an accident. It's the result of a fundamental reshaping of the market, driven by institutional ETFs and a regulatory wall that sets Bitcoin apart. The era of easy money getting sprayed across thousands of altcoins has been put on pause, replaced by a smarter, more top-heavy market. This has been painful for altcoin holders and puts the classic capital rotation theory in serious doubt. The new institutional players don't play by the old rules, and regulations could block the flow of money that once fueled alt seasons. This means it's a tougher world for altcoins, where only the absolute strongest are likely to win. Ultimately, understanding this isn't about being a Bitcoin maximalist. It's about being a realist and a smarter investor. Recognizing these powerful trends is the first step toward positioning yourself to not just survive this new era, but to capitalize on it. If you got value from this breakdown and want to stay ahead of these huge market shifts, do me a favor and hit that subscribe button. We go deep on this channel to give you the insights you won't find anywhere else. And now I want to hear from you. This is the biggest debate in crypto right now. Do you think the classic capital rotation into a massive alt season will happen again? Or has this institutional era broken the model for good? Drop your thoughts in the comments below. Let's talk about it.